right, final touches, get this stuff sorted. Yeah, right, let's have it. Let's start with the most important thing first. The stock market is not some secret underground club full of men yelling numbers while throwing paper around like they're in a finance-themed WWE match. Well, historically, it actually was a bit like that. But today the stock market is much simpler than people think underneath all the intimidating language. At its core, the stock market is just a place where people buy and sell ownership in companies. That's it. That's the whole thing. When you buy a stock, you're buying a tiny piece of a business. Not a line on an app, not the market, a real business. That's the bit people miss. If you buy shares in a company like Apple, you literally become a part owner of Apple. A very, very small owner, obviously. Tim Cook's probably not asking your opinion on the next iPhone design, so sorry to disappoint. But legally speaking, you own a tiny slice of the company. And the stock market is simply the system that allows millions of people around the world to buy and sell those ownership pieces every single day. Today we're breaking down what the stock market actually is, why companies sell shares, why people invest, why prices move, why markets crash, and why investing feels emotionally weird even when you're doing everything correctly. Let's go. I'm Leo, welcome back to Financially Fit Millennial, where we talk about money without the jargon, without the judgment, and occasionally while trying to explain billion-dollar financial systems using supermarket analogies and emotional support humor. You're welcome. Today we're tackling one of the most misunderstood topics in personal finance, because for something that affects almost everybody's retirement, pensions, investments, and financial future, most people are never actually taught what it is properly. People hear terms like shares, stocks, indices, trading, dividends, and understandably their brain just quietly exits the conversation. So let's simplify this properly. Now the obvious question is, why would a company give away ownership in the first place? Money. That's the answer. Imagine you start a business. Maybe you invent the world's greatest protein bar. Gym people become emotionally attached to it immediately. Fitness influencers start pretending they discovered it before everyone else, and demand explodes. Suddenly, your tiny business needs factories, warehouses, staff, advertising, distribution, and of course equipment, all of which costs enormous amounts of money. Now, one option is to borrow money from the bank, but another option is selling part of the company to investors. And this is what happens when a company goes public. The company lists shares on the stock market so investors can buy ownership stakes. This is called an IPO, an initial public offering. Before an IPO, ownership is usually concentrated amongst the founders, early investors, and private owners. After the IPO, ordinary people can buy shares too, like you, which means suddenly everyone with a brokerage account can become a shareholder. And this is one of the most important things the stock market does. It connects businesses that need money with investors looking to grow wealth. The company gets funding, investors get ownership. Everybody hopes the business grows successfully over time. That's the relationship. So why do people put money into stocks? Because historically, businesses grow over time. Not all businesses, some companies fail spectacularly. But overall, economies tend to expand over long periods. Companies innovate, technology improves, products get better, human beings continue buying things they probably don't need, and investors participate in that growth. There are generally two ways investors make money from stocks. First, share price growth. If a company becomes more profitable and valuable over time, investors may be willing to pay more for its shares. So if you bought a share at $100 and later sold it for $150, you made money. Simple. Second, dividends. Some companies share part of their profits directly with shareholders. These payments are called dividends. Think of it like the company saying, thanks for investing in us, here's a slice of our profits. Some investors love dividends because they create regular income. Others focus on long-term growth. Both approaches exist. And honestly, the internet gets weirdly emotional arguing about which one is superior. Right, so what actually makes the stock price move? This is where people start imagining complicated Wall Street wizardry. But at the simplest level, stock prices move because of supply and demand. If more people want to buy a stock than sell it, the price usually rises. If more people want to sell than buy, the price usually falls. That's it. Now, why people suddenly want to buy or sell can be complicated. Things like company profits, interest rates, economic news, inflation, hype, fear, recessions, wars, Elon Musk tweeting something chaotic at 2 a.m. But underneath all of it, prices move because human beings collectively decide what they think a company is worth. And human beings are emotional creatures, which means markets can become optimistic, fearful, irrational, euphoric and dramatic, sometimes all within the same week. This is why stock prices can move violently in the short term, even when the underlying business itself hasn't changed much. Markets are driven partly by fundamentals and partly by human psychology. And human psychology is not exactly famous for remaining calm under pressure. Okay, let's be clear about one thing. The stock market is not the economy. This is important. People often hear the stock market is up and assume the economy must be doing great. Not necessarily. The stock market and the economy are related, but they are not the same thing. The economy includes jobs, wages, housing, spending, businesses, consumers, and the stock market is investors trying to predict the future profitability of companies, which means markets often move before the economy improves or worsens. This is why markets sometimes rise while headlines still sound terrible. And it's also why people trying to perfectly predict short-term market movements usually end up stressed, confused, and watching far too much financial news. The market is forward-looking. It cares more about what investors think will happen next than what's actually happening right now. Right, this is one of the most important concepts beginners need to understand, and that is, what is an index? Because when people say the market went up today, they're usually referring to an index. An index is basically a collection of stocks grouped together. For example, the S&P 500 tracks around 500 large US companies. The FTSE 100 tracks major UK companies, and the ASX 200 tracks major Australian companies. Instead of buying just one company, an index gives exposure to many companies at once. This matters because diversification reduces the risk. If one company performs badly, the others can help balance things out. This is why index investing became incredibly popular, because instead of trying to predict which company wins, which CEO succeeds, or which industry dominates, you simply buy large sections of the market itself. And historically, broad diversified index investing has worked extremely well over long periods. Not because it's exciting, but because boring consistency tends to outperform emotional chaos surprisingly often in investing. One question people want to know is, why do markets crash? Simply because human beings panic. I'm simplifying slightly, but honestly, not by much. Markets crash when investors suddenly become fearful about the future. Things like recession fears, inflation rising, banks failing, wars starting, pandemics happening, or investors collectively realize they became way too optimistic. During crashes, prices can fall very quickly, and this is where investing becomes psychological, because market crashes feel awful emotionally. Even experienced investors feel uncomfortable watching portfolios fall. And this is important. Crashes are totally normal. That's the bit that beginners struggle with. Everyone says, I'm investing for the long term, until the market drops 25% and suddenly people are Googling, should I sell everything and move into the woods? Historically though, markets have recovered from things like recessions, financial crises, war, inflation spikes, political chaos, and of course, global pandemics. Not instantly, not comfortably, but over long periods, markets have historically trended upwards because economies continue functioning and businesses continue to adapt. For some people, investing feels emotionally weird because investing is deeply unnatural psychologically. You're basically being asked to delay gratification, tolerate uncertainty, ignore panic, stay patient for decades, and trust a long-term process while short-term news constantly screams at you. That is not easy. Human beings prefer certainty. We like immediate rewards, which is why gambling feels exciting, shopping feels satisfying, and checking your investment account 14 times a day somehow feels productive, even though it usually isn't. Long-term investing success is often less about intelligence and more about behavior. The people who build wealth are usually not the people making dramatic moves every week. They're often just the people who stayed consistent long enough. Boring answer, I know, but it's still true. One big question people want to know: is the stock market gambling? This is one of the biggest misconceptions. Short-term speculation absolutely can resemble gambling. People trying to predict daily movements, chase hype stocks, trade emotionally, or get rich quickly. They can lose enormous amounts of money, but long-term investing in diversified businesses is fundamentally different because you're buying productive assets. These are real companies generating real profits, selling real products and services. You're participating in long-term economic growth. That's not the same thing as betting on red at the casino. Now, can markets fall? Absolutely. Can investors lose money? Yes. But historically, diversified long-term investing has been one of the most effective ways ordinary people build wealth over time, which is why pension funds, retirement accounts, and institutional investors all heavily use the stock market. So, what is the stock market? At its simplest, it's a giant system that allows people to buy and sell ownership in businesses. That's it. Companies raise money, investors buy ownership, businesses grow, share prices move, markets fluctuate, and over long periods, investors participate in economic growth, sometimes calmly, sometimes while emotionally spiraling during market crashes and Googling whether moving to a cabin in the woods is financially viable. But underneath all the noise, the stock market is really just millions of people collectively investing in the future success of businesses. And once you understand that, investing becomes a lot less intimidating. All right, legends, like, subscribe, and also drop a comment, and I'll see you in the next one.